more of the private variety is Kipp deVeer, Ares Capital CEO. And Ares, of course, manages over $330 billion. Kipp, thanks so much for joining the program. Now, Jamie Dimon warning about cracks in this credit market. Are you seeing any cracks in the private capital credit markets?
Thanks so much for having me. I think what I'd say as of now is not yet. Jamie Dimon obviously has a pretty broad view of the world, so I'll take his 6 to 9 months as something to watch for sure. But when we look through to our portfolio companies today, although we do expect likely defaults to go up this year with the increase in rates and you know, a tougher debt service environment for those companies, I'd probably join him in predicting the next 6 to 9 months could get more difficult. But today we're really not seeing it, Carolyn.
What will that default cycle look like, Kipp? We certainly skipped it during the COVID era. How bad does it get when you're looking at potential defaults next year?
We don't really see anything extraordinary from a historical perspective. If you look today, you know, the default rate on corporate credit is broadly well below what you'd see in terms of historical averages or, you know, means. So I'd expect as we get through the back, you know, half of this fall and into next year that we'll see a trend up more towards the historical average. But I don't see a, you know, terribly uncomfortable environment where it goes way through that.
So, hi, Kipp, it's Alex in New York. So that seems pretty constructive. So then the obvious question is, then where is the opportunity?
Yeah, I mean, the good news is we as you know, private credit participants have more opportunity than we've had, you know, for sure over the last couple of years. I think, you know, there's been plenty of press covering some of the situations that the banks are trying to resolve and some of the larger LBO lending that they've done. And as that resolves, it really creates a lot of fairway for folks that can still originate their own deals, which we do, and structure and price our own deals in the private market. So we're seeing another acceleration in growth in our world, and the environment for investing is getting more and more attractive for us.
So if the banks that were having trouble offloading that debt, and I'm just going to refer to, say, Citrix and Brightspeed, why is that good then for you? Like, what are you seeing that they're not, or that they're seeing that you're not?
Well, I mean, what I'd say is we tend to focus on smaller deals, right? So the banks, as many others have said in the past, and I've said as well, really want to be in the moving business, right? So they want to underwrite larger deals that they can get rated by the rating agencies and sell to investors. We do something a little bit different in the middle market, where we're actually out originating for our own investors and for our benefit with a very large team in the U.S., Europe, and Asia. So we're doing the same thing that they're doing, frankly, in the middle market, but we're now able to charge higher fees. We're seeing wider spreads, and obviously the base rate that underlies most of our loans is a floating rate base rate, so that's up, you know, a couple hundred basis points here in the last 6 months.
It might be better returns, Kipp, but can these companies deal with higher base rates, especially as we look at potential recession on the horizon?
Yeah, I mean, that's obviously the complementary question. For now, we think they can, and we've published a fair amount of stats around both our public BDC and other portfolios that we manage in corporate credit at Ares. But we're still seeing pretty good debt service coverage ratios in our companies, north of 2 times. And we think even with another 100 basis points of rate increases, which is likely from here, that those companies can still service the debt. Now, obviously, that's holding everything else equal. If you see a significant contraction in profits or a deeper recession, that's going to get tougher and tougher. But I think what's often been missed here is what we're seeing in a lot of markets really is a widening of spreads in public credit markets, and we're seeing a revaluation of asset prices, which is, in my opinion, a little bit more problematic for equity investors. Whether you own a building or a company, you're seeing multiple contraction with higher rates. You're seeing less growth. That makes the equity business more challenging. We don't necessarily think it makes the credit business all that much more challenging.
Kipp, what sort of conversations are you having with your portfolio companies right now? For example, are you having to be more lenient with them to prevent any sort of covenant breaches?
I mean, in leveraged finance, whether it's the public markets or the private credit markets, that's sort of a natural occurrence and part of the business. I wouldn't say that that's accelerated, frankly, in the last few months. It accelerated dramatically during COVID when you saw businesses closed. But the quality of credit and the interaction with the portfolio companies today is largely the same. Back to your point about, you know, Jamie Dimon's comments, I too, you know, see a little bit more of a difficult road ahead for the next 6 to 9 months. But again, as of right now, that dialogue really is not different in particular. I think the one thing that we've done proactively here over the last 6 to 8 weeks is go out and take a look at how well hedged those companies are, because there was a lot of floating rate debt borrowed by companies, and we're hopeful that most of those companies took the ability to hedge some of that paper before the interest rate environment changed. So that's something that's front of mind for us.
Yeah, Kipp, I mean, I was not too long ago talking to your European colleague, Blair Jacobson, about this idea. What level do rates need to hit that you do see pain for companies? I know you were saying this before, you're not too concerned, but is there a level of interest rates in the U.S. where you say, oh no, our companies, they're not going to be able to pay this up. This is when the defaults kick in.
Yeah, I mean, for sure, that's pretty simple math, right? I think, again, per my earlier comments, 100 basis points from here is not particularly problematic. 200, 300, 400 basis points from here is going to start causing some problems for companies, for sure. But I'm not sure that's anyone's expectation as to where we're heading.
Kipp, we really appreciate the time. Lots of good stuff to get through. Thank you very much. Kipp deVeer, Ares Capital CEO. Thanks a lot for joining us from the Greenwich Economic Forum.